What if the money in your pocket doesn't actually exist? Not in the way you think. It's not backed by gold or silver or even real labor anymore. It's backed by belief, a shared illusion, carefully maintained and quietly manipulated by forces most people will never see. This is the story of how money stopped being real and how invisible hands came to control the very thing that defines our lives. It's the story of an illusion so powerful, we mistake it for reality itself. Before money became numbers on a screen, it was something tangible, something you could hold, weigh, and trust. Thousands of years ago, people traded goods directly. Wheat for iron, tools for cattle. It was simple but limited. You couldn't carry enough goods to trade efficiently across distances. So humanity invented something revolutionary: symbols of value. Gold and silver emerged as the universal language of trust, rare, durable, and impossible to fake. These metals didn't just represent wealth, they were wealth. By 700 BC, the ancient Lydians began minting standardized coins. For the first time, value could travel faster than goods themselves. But that moment was also the birth of illusion. The instant we agreed that a stamped piece of metal was worth something beyond its substance, we began to trade symbols instead of value itself. Centuries later, the illusion deepened. In medieval Europe, merchants faced a problem. Gold was heavy, risky to carry, and easy to steal. So they began depositing their coins with goldsmiths, people who had vaults and trust. In return, they received paper receipts confirming their deposits. These receipts over time started to circulate as money themselves. People began trading them instead of the gold they represented. But the goldsmiths noticed something remarkable. Not everyone came to collect their gold at the same time. That meant they could issue more paper receipts than gold actually existed. No one would notice unless everyone demanded their gold back at once. With a pen stroke, they created money out of nothing, a promise without substance. Wealth that existed only on paper. The goldsmiths became bankers and money became belief. From there, the illusion spread. In 1694, England was drowning in debt after endless wars. The crown needed money, and a group of private financiers had an idea. They would lend money to the government, but in exchange, they wanted something extraordinary: the right to issue it. That was the birth of the Bank of England, the world's first central bank. The government could now borrow endlessly. The bankers, in turn, were repaid through taxation. It was a perfect symbiosis: power for stability, debt for control. The model spread across Europe and eventually to America. When the United States was born, the Founding Fathers fiercely debated one question: who should control the nation's money? Alexander Hamilton wanted a national bank. Thomas Jefferson warned that if private banks controlled the issuance of currency, they would strip the people of their property until their children woke up homeless on the continent. Their fathers conquered, Jefferson lost. The first Bank of the United States was created in 1791. 20 years later, it was dismantled, only to be replaced by the Second Bank, and later destroyed again by President Andrew Jackson, who called it a den of vipers. For a time, it seemed democracy had won, but the bankers waited. The financial panics of the early 1900s provided the perfect excuse. The people demanded stability. What they got was control. In 1910, a group of powerful men met secretly on Jekyll Island, off the coast of Georgia. Among them were representatives of J.P. Morgan, Rockefeller, and the political elite. Under the guise of a hunting trip, they drafted a plan for a private banking cartel that would quietly control the nation's money supply. In 1913, their plan became law. The Federal Reserve was born. From that moment on, every U.S. dollar would enter circulation as debt borrowed from a central bank, owed back with interest. It was a perfect mechanism. To keep money flowing, debt had to keep growing. Money had become an illusion backed not by gold, but by obligation. For decades, the illusion was tethered to something tangible. Under the gold standard, each dollar represented a fixed amount of metal held in reserve. But war has a way of rewriting rules. During the Great Depression, President Franklin Roosevelt confiscated private gold holdings, promising stability while quietly transferring wealth to the government's control. Then, in 1971, President Richard Nixon ended the gold standard entirely. The dollar was no longer redeemable for gold. From that day on, money was backed by nothing but confidence, faith that the government would maintain its value, even as it printed more of it. The illusion was complete. Money became paper, then digits, then data. It could be created with a keystroke, expanded infinitely, and destroyed just as easily. The constraints of physical reality were gone. The age of infinite money had begun. In this new era, everything became debt. Governments borrowed to fund wars and welfare. Corporations borrowed to buy themselves. Consumers borrowed to live beyond their means. Each dollar was born as someone's liability. Each new loan expanded the supply. Every repayment contracted it. The system was self-sustaining until it wasn't. By the 1980s and 1990s, technology amplified the illusion. Electronic trading replaced paper. Derivatives financial contracts built upon other contracts multiplied exponentially. By the early 2000s, there were more derivatives in existence than actual assets on Earth. Trillions of dollars in value were now purely theoretical money, made from money, detached from reality. And then came the crash. In 2008, the illusion shattered. The system built on confidence suddenly faced doubt. Lehman Brothers collapsed. The world's largest financial institutions teetered on the edge. Trillions evaporated overnight. To save it, governments printed money more than ever before. They called it quantitative easing. In truth, it was the same old trick. Create money from nothing and hope people still believe in it. The system survived, but at a cost. Every rescue required more debt than the last. Every crisis demanded a bigger illusion. By 2020, central banks around the world had printed more money in 1 year than in the previous 2 centuries combined. The pandemic didn't create the illusion, it merely revealed how deep it ran. Today, global debt exceeds $315 trillion, 3 times the world's total annual production. That means every dollar of real productivity is shadowed by $3 of debt. The illusion continues because belief continues. As long as people accept paper or pixels as payment, the system endures. But every illusion has a breaking point. History shows the pattern. Ancient Rome debased its silver coins until they were almost worthless. The Chinese emperors printed so much paper currency that inflation destroyed entire dynasties. France's revolutionary assignats collapsed within a decade. Each time, the illusion promised prosperity. Each time, it ended in ruin. The difference now is scale. Our illusion is global, digital, and instantaneous. It touches every transaction, every paycheck, every savings account, and it is controlled not by kings or emperors, but by committees of unelected technocrats. They adjust interest rates, issue statements, and move markets with a sentence. They promise stability while feeding volatility. They are the new high priests of money, the invisible hands that guide the illusion. They say their job is to maintain trust. But trust in what? A system that creates debt faster than it creates value? A currency that can be printed without limit, but loses purchasing power year after year? Inflation isn't a rise in prices, it's a decline in faith. Each new dollar dilutes the old ones. Each new bailout steals silently from savers. The illusion demands expansion, and expansion demands sacrifice. To keep the system alive, you must keep believing, but belief is fading. Younger generations see that saving doesn't work, that wages lag while prices rise, that wealth concentrates at the top while debt spreads below. They see that the illusion rewards speculation over creation, financial engineering over honest work. They see that the house always wins, and the house is owned by the same hands that control the money supply. And now, a new illusion is emerging. The rise of digital currencies, Bitcoin, Ethereum, and thousands of imitators, was born from distrust in central control. They promised transparency, decentralization, and freedom. But central banks have noticed. Around the world, they're developing their own digital currencies, CBDCs. Central bank digital currencies will replace cash entirely. Every transaction recorded, every account traceable, every payment programmable. The next evolution of money is not physical or even private, it's algorithmic. It can be limited, delayed, or denied with code. And when that happens, the invisible hands no longer just influence money, they define it. We are approaching a paradox, a world that needs trust more than ever, but offers less of it than ever before. If global debt is 3 times the value of global production, then mathematically, it can never be repaid. The system survives only by creating more debt. Like a shark that must keep swimming to breathe, it cannot stop expanding. But infinite growth cannot exist on a finite planet. Something will give. And when it does, history tells us what follows: default, devaluation, and reset. The reset may not come as a dramatic collapse, but as a slow erosion, currencies losing value year after year until they're replaced by something new. It might be digital money, or resource-backed credit, or something yet unseen. But whatever form it takes, the principle remains the same. Those who control the creation of money control the direction of history. They always have. And yet there's another side to this story. The illusion only works because people accept it. When belief shifts, so does power. When individuals question what money truly represents, they begin to see that wealth is not just paper or pixels, it's time, skill, and energy. True value lies in things that cannot be printed: knowledge, creativity, resilience, and community. These are the assets that survive when illusions fade. The lesson is as old as civilization. When money ceases to represent real value, collapse follows. When a system forgets that wealth must be earned, not conjured, it eats itself from within. We are living through that forgetting. Yet it's not too late to remember. The first takeaway is simple. Money today is not wealth. It's a mechanism of control, designed to direct behavior and concentrate power. Understanding this is the foundation of financial awareness. The second takeaway: every crisis sold as a solution expands the illusion. The more we rely on bailouts and printed prosperity, the less stable the system becomes. Stability doesn't come from printing, it comes from productivity. And the third takeaway: history always rewards those who rediscover tangible value. Whether it's gold, innovation, or self-sufficiency, real wealth is always built outside the illusion. When money becomes illusion, freedom becomes conditional. Our generation stands at the edge of a new monetary world, one where every transaction could be tracked. Every rule enforced, every permission granted or revoked by unseen hands. It may look efficient, it may even feel safe. But safety built on control is just another illusion. The question isn't whether this system will change, it's when and how. When the illusion fades, will you be one of those waiting for the next promise? Or one of those who already understands what value truly means? Knowledge is the only currency that can't be devalued. Understanding the illusion is your first act of freedom. Because the moment you see that money isn't real, you begin to understand what actually is.